These days around 62% of Americans invest in stocks. And if you look at the S&P 500, it's nearly doubled in the last 5 years. So you'd think everybody's getting rich, right? Well, you'd be dead wrong. Here's the thing. Wall Street has a little nickname for most Americans. They call them capital donors. Why? Because about 75% of regular people actually lose money investing in stocks, just making the rich richer. Right now, the wealthiest 10% of Americans own nearly 90% of the entire stock market. So clearly, there's like a massive difference between how regular people invest and how the rich really do it. And today, we're going to show you exactly how rich people invest in stocks, from the basics to the billionaire playbook. Welcome to Billionomics, where the true billionaires are born. Let's start with regular people, because to really understand why the wealthiest 10% succeed, you need to see the other side of the coin. Here's a surprising fact. Around 75% of retail investors end up losing money over time. And the reason isn't lack of money, it's behavior. Most retail investors think they can outsmart the market, like they're some kind of financial Sherlock Holmes. So what do? They try to pick the next hot stock, hoping to catch the next Amazon or Tesla before anyone else notices. Time the trades perfectly, believing they can predict every market swing. Follow random advice from Reddit, TikTok, or Twitter, trusting strangers more than strategy. But here's the reality. Stocks aren't that easy. The market doesn't care about hype, memes, or viral posts. Most retail investors buy high when everyone's hyped, and panic sell low when fear sets in. That's why Wall Street has a nickname for them: capital donors. Their money often ends up in the hands of professional investors who are ready to profit from their mistakes. Now, don't get discouraged. It's not all doom and gloom. Many people do manage to build real wealth in the stock market, and it usually starts with the basics. Most beginners start with blue-chip stocks. These are massive, reliable companies with a long history of growth, profits, and dividend payouts. Think of them as the safety net of investing. The strategy is simple: buy, hold, and let it compound over time. You're not chasing quick wins, you're letting the power of compound interest do the heavy lifting. For example, with Apple, if you bought shares 5 years ago, you'd have nearly doubled your money just by holding. With Microsoft, over the past decade, long-term holders have seen over 600% growth. But here's the catch. Putting all your money in one stock is risky. What if that company gets hit by a scandal, regulatory trouble, or falls behind competitors? Your entire portfolio could take a hit. That's why many investors diversify. And the easiest way to do that is with index funds and ETFs. Index funds and ETFs allow you to buy tiny slices of hundreds or even thousands of companies all at once. Instead of hoping one stock goes up, you're betting on the market as a whole. Most people access these through 401ks, Roth IRAs, or brokerage accounts, which often come with tax advantages. Over time, even a simple strategy of buying and holding can outperform most individual stock picks. But diversification doesn't stop there. Skilled investors also spread their investments across different sectors: tech, healthcare, energy, consumer goods, international markets, emerging markets, Europe, Asia, other asset classes, bonds, real estate, REITs. The goal isn't to chase the highest possible return. No, it's about reducing risk and smoothing out volatility. If tech stocks take a hit, your healthcare or international investments can balance things out. So for most regular investors, the journey ends here: blue chip stocks, index funds, ETFs, and diversification. It's low effort, low cost, and historically high reward. The kind of strategy that can steadily grow wealth over decades without stress or guesswork. And yet, despite all this, there's still a massive gap between what the average investor earns and what millionaires or billionaires make. Why? Because they take their investing to the next level using strategies most people don't even know exist. Now, let's dive into how millionaires invest in stocks. Yes, they pick individual stocks, but here's the difference. They do it strategically, not impulsively. Regular investors might chase the latest hot stock or follow a Reddit trend. Millionaires? They look for companies that are undervalued, those with strong fundamentals but overlooked by the market. They also focus on consistent dividend payers, which provide a reliable stream of income. And of course, some hunt for the next Amazon, Google, or Tesla before the world catches on. The key is research, discipline, and patience. They analyze earnings reports, checking profitability trends. Revenue growth? Is the company expanding sustainably? Debt levels. Can the company survive a downturn? Management quality. Is the leadership capable of long-term success? Industry trends. Will the company thrive in the market of tomorrow? Even the best stock picks can go wrong, which is why protecting their money is just as important as making it. Take Mark Cuban in 1999. After selling his company to Yahoo, he ended up with $1 billion in Yahoo stock. He knew the dot-com boom couldn't last forever, so he hedged his investment using a strategy called an options collar. Here's how it worked. He bought a put option, giving him the right to sell Yahoo stock at a fixed price. Even if the stock crashed, he was protected. He sold a call option, giving up the chance to make even more money if Yahoo soared, which offset the cost of the put. When the dot-com bubble burst, Cuban didn't lose a dime. That's smart investing, limiting risk while still keeping upside potential in check. Another tool millionaires use is margin and leverage. Imagine this. You have $1,000 to invest, but you borrow another $1,000. Now you're investing $2,000. If the investment goes up, you make almost twice as much profit. If it goes down, you lose twice as much. It's high risk, high reward, definitely not for everyone. But when used wisely, it can accelerate wealth accumulation. Millionaires also often invest through hedge funds, private investment firms managing multi-billion-dollar portfolios. These aren't just picking random stocks. Hedge funds like Bridgewater Associates, founded by Ray Dalio, focus on global macro trends, how interest rates in China impact oil prices, or how inflation in the US affects corporate earnings in Europe. Event-driven strategies, mergers, bankruptcies, regulatory changes, absolute return goals, aiming to make money in both bull and bear markets. And then there's the cutting-edge world of quantitative funds like Renaissance Technologies, founded by Jim Simons. These funds don't rely on gut feelings. They use algorithms and massive data sets. Make thousands of trades per day. Exploit tiny, repeatable market inefficiencies that humans can't see. Achieve astonishing returns, 66% annually before fees, year after year. For example, one quant algorithm might notice that a tech stock rising 1.5% in the first hour tends to dip slightly by the afternoon. The algorithm then shorts the stock automatically for a few hours, capturing predictable gains. Another might analyze satellite data like droughts affecting Midwestern crops to anticipate fertilizer stock movements a week later. At this level, investing becomes less about intuition and more about data, mathematics, and systems. The more money you have, the more sophisticated and powerful the strategies get. And that's why millionaires consistently outperform average investors, even when regular people follow all the buy, hold, and diversify advice. So remember, millionaires invest with strategy, discipline, and research. Protecting wealth is just as important as growing it. Sophisticated tools like margin, leverage, hedge funds, and quantitative trading separate the wealthy from the average investor. Investing at this level requires time, expertise, and access to advanced financial instruments. Now we get to the ultra-wealthy. Hedge funds are impressive, but billionaires need something bigger. Family offices. A family office is a private team handling investments, taxes, estate planning, legal strategies. Private equity is common here, buying into private companies or startups before they go public. Examples: Jeff Bezos and Google, 1998. Peter Thiel's $500,000 Facebook investment to $1 billion. Elon Musk and Stripe. Another strategy: tax loss harvesting, selling losing investments to offset gains and pay less tax. Then there's the buy, borrow, die strategy used by Elon Musk. Keep stock instead of selling, borrow money against it, use funds while avoiding capital gains tax. When passed to heirs, capital gains tax disappears. Finally, billionaires often donate appreciated stock, reducing tax liability and benefiting causes. Warren Buffett has donated $50 billion in Berkshire Hathaway shares this way. So there you have it. That's how the rich really invest in stocks. Regular people, blue chips, ETFs, diversification. Millionaires, stock picking, hedging, hedge funds. Billionaires, family offices, private equity, tax strategies. But here's the truth. Investing isn't how people get rich. It's how they stay rich. If you watched our last video on net worth versus cash flow, you know building wealth isn't just about what you have. It's about what actually gives you freedom. Today, we dug deeper into how regular people, millionaires, and billionaires invest. And you can probably see how these ideas connect. It's not about chasing hype, it's about building systems that work for you. If you're ready to take the next step and actually apply these wealth-building strategies, check out our channel and just join our Billionomics family. Keep stacking that cash flow and keep investing wisely. See you in the next one.